Good afternoon, everyone, and good morning to those of you joining us on the West Coast today. Siegel Rogers Casey would like to welcome you to today's webinar presentation. It's our investment synopsis, second quarter 2013 capital market review. Now I would like to introduce our speakers. First, we have Chris Thompson, Senior Vice President. We have Namisha Patel, Associate Director, and David Stewart, also Associate Director. Now I'll turn the call over to Namisha.
Hey everyone, thanks for joining our call today. I'm going to start touching on a couple macro indicators during the quarter, the first being GDP. So this chart shows the GDP growth on an annualized and year-over-year basis. In Q2, GDP grew at an annualized rate of 1.7%. This is up a little bit from Q1, which grew at 1.1%. And some of the positive contributors included personal consumption expenditures, exports, non-residential fixed income investments, and residential. Some of the detractors included an increase in exports and a decrease in government spending. The government sector continues to be a drag on GDP, which is the biggest detractor. However, revisions are due on August 28th to this number, so we will see what that comes out with. Most economists are forecasting GDP to grow in Q3 and Q4 about at an annualized rate of 3%. So they are pricing in a slight uptick.
This is Chris. I just wanted to add a little bit of color to that. Namisha's comment that the growth on the specific growth rate, and also commenting on the negative impact of government spending, highlights something that we've been seeing, particularly in the equity markets. And I'm going to come back to that a little bit later in a slide that I'm going to show. But this trend of pretty moderate GDP growth coming out of the global financial crisis from basically 2009 onward has translated into some materially good corporate profitability, particularly in the developed markets like the U.S. So just something to keep in mind that, while we don't necessarily believe there's a linear correlation between, say, economic activity and economic fundamentals and then stock prices, there's certainly a relationship. And so it's a little bit of a trend that we're seeing kind of across the developed markets.
Thanks, Chris. Switching over to CPI, this chart shows both the headline CPI and core CPI percentage change on a year-over-year basis. In Q2, headline CPI grew at 0.2% in Q2, which translates to 1.76 on a year-over-year basis. This is a little bit below the 2% target that we've heard the Fed talk about. Some of the positive contributors to this number was gas, electricity, while some negative detractors included natural gas, fuel, and energy was somewhat mixed during the quarter. When you look at the core CPI number, which is the green line, this excludes food and energy, and this grew at just a little over 0.2% in June and 1.64% on a year-over-year basis, so slightly lower than headline CPI. Again, economists expect this to bump up to about 2% next year and anticipate a range of no more than 2.5% over the next 1 to 2 years. Something that's not pictured here is the 10-year break-even inflation rate. This fell to 1.99% in Q2 from 2.52% in Q1, so dropped just below the 2% number which the Fed and the FOMC has been targeting. Looking a little bit at monetary policy, this chart shows the target rates in the U.S., Eurozone, and Japan. Starting in the U.S., at the June FOMC meeting, the Fed announced that they would continue to purchase $40 billion in mortgage-backed securities and $45 billion in long-term treasuries, so very much continuing their quantitative easing despite some earlier comments that they may in the future start to cut back. They've also continued their low-rate policy of 0 to 0.25% as long as unemployment stays above 6.5%.